Have you ever stopped to ask where the money in your bank account actually comes from? Most people assume the bank is just holding cash that other savers deposited. That picture is wrong. Almost all the money you use every day was created by a commercial bank out of thin air the moment somebody borrowed it.
And this is not a conspiracy theory. The Bank of England published it in plain text in their 2014 quarterly bulletin. The textbook story you may have learned, where banks just lend out the deposits of savers, is incorrect. The reality is the opposite. Loans create deposits, not the other way around.
So here is the question we are going to answer today. If commercial banks really invent the money they lend, what stops them from creating infinite amounts of it? And what does that mean for the value of the savings sitting in your account right now?
3 ideas in order. First, how a bank loan actually creates a deposit. Second, why the old multiplier model from your textbook is wrong. Third, what really limits money creation in the real world. By the end, you will have a clean mental model of how modern money is born. Let's get into it.
If you open your banking app right now, the balance you see on that screen, it isn't actually a money printed by a central bank. It is, well, quite literally, the ghost of someone else's debt. Welcome to the deep dive. We are looking at a system today that just completely defies the basic physical logic of everyday life. I mean, if you have a physical pie and you give half of it away, you only have half a pie left, right?
Right, exactly.
We just assume money works the exact same way. We assume that when you deposit 1,000 euros into your current account and the bank subsequently lends 1,000 euros to someone else, there's a clear sequence. But, when you log into your app, your 1,000 euros are still sitting there, fully available to spend. Meanwhile, the borrower is out at a car dealership simultaneously spending their new loan. So where did that second 1,000 euros actually come from?
It really looks like a structural contradiction from the outside. People look at that double spending power and they often fall straight down a rabbit hole of conspiracy theories about shadow banking. But we are going to look at the actual documented mechanics today.
Right, because we aren't dealing with internet forums here. We have a physical stack of official, highly credible reports right in front of us. We are looking at a landmark 2014 paper from the Bank of England, authored by Maclay, Radia, and Thomas. We also have the Deutsche Bundesbank's April 2017 monthly report, and we are pulling from official European Central Bank monetary statistics. The goal is to lay out the mind-bending reality of how commercial banks actually create money. But to understand the reality, we kind of have to clear out the myth first. We have to talk about the money multiplier.
Oh, the standard economics 101 textbook model. It is incredibly pervasive and, well, it establishes a totally false baseline for how people think about the financial system.
So listeners are probably familiar with the core concept, but let's visualize it just to be sure. It's usually taught like a row of people passing a bucket of water. The central bank sits at the beginning of the line. They print the original water, the reserves, and pour it into the first commercial bank's bucket.
Yeah, that's the classic analogy.
And then that bank keeps a tiny film of water at the bottom to meet their reserve requirement, and then pours the rest into the next bucket, which represents a loan. The next bank gets the water, keeps a tiny film, and pours the rest onward. The logic is sequential, Gathering savings flows first, lending flows second. A bank has to gather water before it can pour it.
Which aligns perfectly with our intuition about physical commodities, and it is completely factually incorrect.
Okay, let's unpack this. If that is the standard model taught in universities globally, why is it a paradox? I mean, why is it wrong?
It's more of an anachronism that turned into a myth. The fractional reserve multiplier model made a bit more sense historically, maybe under a strict gold standard, where physical reserves were the absolute binding constraint on lending. But in modern banking, the causal direction is entirely reversed. Let's look at the Bank of England's 2014 quarterly bulletin.
What do they say about it?
The authors state explicitly that this textbook description is entirely misleading. They write, and I quote, "Rather than banks receiving deposits when households save and then lending them out, bank lending creates deposits."
Wow.
And the Deutsche Bundesbank's 2017 report echoes this almost verbatim, stating that a bank's ability to grant loans has nothing to do with whether it already has enough deposits.
So the central banking authorities themselves are actively debunking the university textbooks. That is a massive paradigm shift. You're saying loans do not wait for deposits.
Exactly. Loans come first. Commercial banks do not lend out pre-existing deposits in a multiplier sequence. The reserves and the deposits adjust afterwards. The bank originates the loan, and that act creates the money.
Wait, here's where it gets really interesting. If local commercial banks aren't pouring water from an existing bucket, what exactly is happening when they approve a loan?
We have to look at the anatomy of a commercial bank's balance sheet. It has two sides. On one side, you have assets, which represent what is owed to the bank. On the other side, you have liabilities, which represent what the bank owes to others.
Okay, so assets are the bank's claims, liabilities are the bank's obligations.
Correct. When a commercial bank approves a loan, it does not walk down to a vault to check for pre-existing funds. It simply makes two simultaneous accounting entries. It creates a new asset, which is the borrower's legal obligation to pay the bank back over time.
Right?
And in that exact same millisecond, it creates a new liability, a brand new deposit in the borrower's current account. Both entries appear instantly. They are created out of nothing but the legal agreement between the bank and the borrower.
So it isn't a bucket at all. It feels more like a legal contract, like a notary public stamping a document. I mean, if a notary drafts an agreement between two parties, the act of writing the document creates an obligation and a right simultaneously.
That's a great way to think about it.
You aren't waiting for prior paperwork to arrive from somewhere else. Both sides of the reality arise together, instantly, on the exact same page, the moment the ink dries.
Yes. Think of what happens when the bank's internal software registers that signature. It expands the balance sheet on both sides. And this isn't just theoretical accounting terminology. You know, we have rigorous empirical literature backing this up.
Really, how do you improve that?
In 2014, an economist named Richard Werner published a study where he empirically demonstrated this exact mechanism.
Did he just look at aggregate data? Or?
No. He actually gained unprecedented access to the internal IT software of a live cooperative bank in Germany. He tracked a specific loan of 200,000 euros being issued to a borrower. He monitored the bank's internal ledgers and their external reserve accounts at the exact moment the loan was granted.
Okay, so if the textbook model was right, he should have seen a transfer of external funds first.
Exactly. He should have seen a check against the bank's reserve balances before the loan was credited.
And what did he actually see?
Absolutely no transfer of external funds. The bank did not check its reserves. The balance sheet simply expanded. The software added 200,000 to the asset column and 200,000 to the liability column. The money was created internally, literally out of nothing.
That is wild.
It was the first time this was documented so granularly in an empirical study, proving that the dual entry expands the money supply.
Which means, connecting this back to you listening right now, the deposit in your current account that you use to pay rent or buy groceries, that is not central bank money.
Yeah.
It is a private liability of a commercial bank.
It is essentially an IOU from a commercial bank, created the exact moment someone somewhere took out a loan.
But hold on, let me stop you right there because I have to push back on this. If a bank doesn't need my deposited money to hand to a borrower, I mean, if they can literally just type money into existence on their balance sheet, why are they constantly bombarding me with emails offering 4 or 5% interest to open a high-yield savings account?
That's a very fair question.
Why are banks fighting so hard for my deposits if they don't actually need them to lend?
That is the core point of confusion for most people. They don't need your deposits to create the loan. They need your deposits to settle the transfer when the borrower spends that newly created money.
Okay, I need a concrete example for this so I don't get lost in the accounting terms. Let's walk through that exact 200,000 euro mortgage Werner observed, step by step, because I want to understand where the clearing process comes in.
Sure. Let's track the 200,000 euros on a Tuesday morning. Step 1, a buyer walks into Bank A and asks for a mortgage to buy a house. Bank A does not check its vault. It evaluates the buyer's credit, their income, and the collateral.
Right, they're just assessing the risk of the asset they're about to create.
Precisely. Upon approval, step 2 and 3 happen simultaneously. The bank initiates the keystrokes. Asset side Bank A records a 200,000 euro loan owed by the buyer. Liability side Bank A credits 200,000 euros to the buyer's current account.
And just to emphasize this, that deposit did not exist before this morning. Bank A just keystroked it into reality.
It did not exist. Now we hit step 4, which answers your question about why banks want deposits. The buyer takes that newly created 200,000 euros and wires it to the seller of the house.
Okay.
Now, if the seller also uses Bank A, nothing changes externally. The deposit just moves from the buyer's account to the seller's account within Bank A's internal balance sheet.
Bank A just changes the name on the liability. Easy enough.
But what if the seller uses Bank B? When the buyer wires the money, Bank A suddenly owes Bank B 200,000 euros. Bank A cannot just send its own typed-up IOUs to a rival bank.
Right. Bank B wouldn't accept that.
Exactly. Bank B demands to be paid in actual, real central bank reserves. This is the back office plumbing. The two commercial banks settle this transfer between themselves using central bank reserves held at the central bank.
Ah, I see. So Bank A needs actual central bank reserves to settle the outflow when the money leaves their ecosystem.
Which is exactly why they offer you 4% interest on your savings account. When you deposit your salary into Bank A, you are bringing central bank reserves into their ecosystem. They stockpile retail deposits because it gives them the liquidity they need to settle their massive daily outflows with other banks. They use your deposits for clearing and liquidity management, not for originating the initial loan.
That makes total sense. It totally resolves the cognitive dissonance there. They type the loan into existence, but the moment that loan is spent at a different bank, they need real reserves to cover the transfer.
Yes, exactly.
But still, just synthesize the sheer scale of this. The money supply available to households in that economy just grew by 200,000 euros. No prior saver had to lock away their hard-earned cash for this to happen. The mortgage itself created the deposit.
And the Bundesbank's 2017 monthly report uses this exact structural example to explain the process to the public. It clarifies that the settlement process is just clearing after the fact. The creation happens at the moment of the loan.
Wait, if local commercial banks are typing this money into existence on their own balance sheets, I'm suddenly looking at the central bank and wondering, what are they actually doing? Are they just a glorified clearinghouse?
It's a valid question.
Because listeners are likely familiar with the official monetary aggregates, moving from M0 to M3. But I want to look at the actual proportions. How much of the money in the wild is real central bank money?
Let's briefly define those layers to see the relationship. Think of them as 4 nested concentric rings. The innermost ring is M0, the monetary base.
Okay, the center ring.
This is physical cash and the commercial bank reserves held at the central bank. This is the only money the central bank creates directly.
And as we just discussed, those reserves in M0 are mostly used by commercial banks to settle up with each other behind the scenes.
Exactly. Then you move out to the second ring, M1. This adds the everyday current account deposits, the newly created loan money we were just talking about, which you can spend instantly.
Right, the stuff people actually use to buy coffee.
Yes. Then the third ring, M2, adds short-term savings deposits, like money parked for up to 2 years or redeemable at 3 months' notice. Finally, the outermost ring is M3.
The broad money supply.
Right. M3 adds short-term liquid instruments like money market fund shares and short-dated debt securities.
So M3 is essentially the total available purchasing power in the economy. What is the structural truth here? What is the ratio? How much of M3 is the central bank's M0?
In the euro area, the central bank issued portion is a tiny share. When you look at broad money, M3, around 90% is bank-created deposit money.
90%.
Around 90%. And this isn't an anomaly of a specific economic cycle or a temporary glitch in the system. It is the permanent structural reality of the system.
That is just incredible.
The vast majority of what we consider to be money is a private sector creation. The central bank manages the core settlement layer, but the commercial banks are the engines expanding the actual broad money supply.
Let's bring everyone back up for air and synthesize the journey we've just been on, because it completely rewrites the causality of the economy. Most of the money you use every single day to pay your rent, to buy groceries, it was created by a commercial bank the exact moment somebody, somewhere, signed a loan document. The textbook multiplier model, the whole buckets of water passing down the line thing, is a myth based on outdated constraints. Loans don't wait for deposits. The banks write the assets and liabilities into existence simultaneously, and that typing makes up 90% of the broad money supply.
It is a complete reversal of our standard intuition, but I know where the mind actually goes next with this.
Where's that?
Well, if creating money out of nothing is the reality, it sounds like commercial banks have a dangerous license to just print unlimited wealth. People usually ask, why don't they just originate a €1 billion loan for themselves every morning?
Seriously. I mean, if I had a keyboard that created money, I wouldn't stop typing until I bought a private island. There has to be a mechanism that stops them.
There is, and it is vital to understand that commercial banks cannot just print at will. There are strict, complex boundaries governing this process.
Okay.
While the European Central Bank doesn't directly print the broad money, they heavily regulate its creation. They use precise constraints, like capital adequacy requirements, liquidity coverage ratios, interest rate corridors, macroprudential buffers, and reserve remuneration.
So the ECD acts more like a regulator of the printing press rather than the printer itself.
Exactly. They set the price of the reserves that banks use to settle with each other, and they mandate how much risk a bank can carry relative to its capital. If a bank writes too many bad loans, those loans default. The assets disappear from their balance sheet, but the liabilities, the deposits they owe, remain.
And that's how a bank goes under.
That is how a bank goes insolvent. The risk of bankruptcy is the ultimate constraint on money creation. Now, how the ECB maneuvers all of that is an entirely different, incredibly complex machinery.
Right, and we are absolutely going to dive into the weeds of those ECB constraints in a future deep dive. We'll open up exactly how capital requirements act as the brakes on this system. But for today, it was crucial to just map out the engine itself.
You really cannot understand how the central bank steers the economy until you understand that the commercial banks are the ones actually pressing the accelerator.
Exactly. So before we wrap up, we've spent this entire deep dive proving that money is born the second a loan is created, which raises a massive provocative question for you to think about tonight.
It's a big one.
It really is. If a loan creates money out of thin air, expanding the global money supply, what exactly happens to the global money supply the moment you pay your loan back?
This is educational content, not a buy or sell recommendation. Understanding how money flows is a map, not a prediction. Your numbers, your horizon, your risk.
Quick recap. Most of the money you use today was created by a commercial bank the moment somebody borrowed it. Around 90% of broad money in the euro area is bank-created deposit money, not central bank cash. And the textbook multiplier model you may have learned is wrong. Loans create deposits, not the other way around.
In the next episode, we open how the central bank actually regulates this creation. Subscribe so you don't miss it. This is educational content, not a buy or sell recommendation. Understanding how money flows is a map, not a prediction. Your numbers, your horizon, your risk.